What are the incomplete records? Incomplete records occur when information has been lost because of disaster, some sort of fire, flood, theft, etc. Inadequate or missing accounting records are available to the bookkeeper. There are differences between ledger accounts, non-current asset register, and physical non-current assets held by the business. Inventory total and the physical inventory held by the business, there might be a difference between these two. Cash book and bank statement received by the business, there might be some difference in both. Purchase ledger account and statement received from the supplier. Timing difference, for example, goods have been ordered but not yet received. A payment made for purchases have been sent but are not recorded on the bank account. Information available to accountant. The basic financial record kept by most businesses is cash book, which records cash and bank transactions. Cash book here is operated by single entry. Only one aspect of transaction is being recorded. Cash book, if not available, can also be made using banking records. Other financial information available: cash book, bank details, statements, paying in books, check stubs, bank transfer, invoices, both received for purchases, sent to for sales, expenses during the year, trade payables and trade receivables. Also, there is some information available to accountant in the form of assets and liabilities, non-current assets and current assets, long-term and current liabilities at the beginning and end of the year. Non-current assets bought or sold during the year. These were all informations which might be available to a bookkeeper or an accountant when he or she is doing double entry bookkeeping system, a single entry bookkeeping system. Information which may not be available and will need to be calculated is capital at the beginning of the year, purchases and sales for the year, cash book summary for the year, profit or loss for the year, drawings for the tools of accounting, how to take financial information that is available and using the tools of accounting so to construct required accounts. Use of an opening trial balance or statement of assets and liabilities, construction of cash account and or bank account, use of control accounts, sales ledger control account, purchases ledger control account and VAT control account. Preparation of financial statements, statement of profit or loss and statement of financial position, accounting equation, gross profit markup and opening capital. Opening capital is needed because a year-end statement of financial position is to be prepared. Accounting equation, assets minus liabilities is equal to capital. This is presented as a statement of assets and liabilities. Now it's an opening trial balance. Balance of different accounts on 1st January 2004 has been shown on the left hand side and balances of different accounts according to 31st December 2004 has been shown on the right hand side. In the bottom there is a bank summary, like all the receipts and payments and drawings, all the transactions which has gone through the bank. There is a summary of it in the bottom of this picture. Now if you want to prepare a statement of assets and liabilities, assets, under the heading of assets you put on all the assets like shop fittings costing £8,000, inventory £25,600, trade receivables which is your asset and it is £29,200, and bank which is £5,000. The total of it is £67,800. These are your total assets. Now if you take the liabilities out of it, you will find the capital figure according to the accounting equation. So here we got two liabilities: trade payables, administration expenses owing 200. So when we add these two, it's 21,000. So total assets are £67,800. When we take 21,000 which are your liabilities. Out of it, the remaining amount is 46,800. That is your capital. So that was statement of assets and liabilities, where you record all your assets first, add all the assets, and then record all the liabilities, add all the liabilities. At the end, take liabilities out of the assets, and the accounting and the rest of the amount will be your capital according to the accounting equation. Cash book summary enables us to find out the cash and bank balances at the year end. Again, we have the same figure, a trial balance according to 1st January 2004, and then a trial balance at the end of same year, 31st December 2004. At the end, we have bank summary. When we construct a ledger for cash book, balance brought down, debit balance 5,000. It is according to the start of the year. When we according to the trial balance at the beginning of the year, balance brought down was 5,000. Payments to trade payables, total payments were made of 82,600 pound. Owner took some money for his own personal use under the heading of drawings. It's 12,500 pound. Administration expenses were 30,600 pound. Receipts from trade receivables, like the people who bought something from us and then they have paid. When you receive money from someone, you have to debit it. So we got two amounts on the debit side, which is balance brought down 5,000 pound, receipts from receivables 127,800 pound. On the credit side, we have payments to the trade payables 82,600 pound, drawings 12,500 pound, then administration expenses 30,600 pound. So if you balance these two sides, the balance carried down is 71,000, which was the missing figure. Purchases for the year. In order to calculate purchases, we need to take note of the following items: payments in year, trade payables at the start of the year related to previous accounting period, trade payable at the end of the financial year. Purchases for the year is equal to payments in year minus trade payable at the start of the year plus trade payable at the end of the year. Take note of purchases, returns, discount received, etc. Sales for the year. Take note of the following in calculating sales for the year: receipts in a year, trade receivables at the start of year related to the previous accounting year, trade receivables at the end of the year. Sales for the year can be calculated by receipts in a year minus trades receivables at the beginning of the year plus trades receivable at the end of the year. Take note of discounts allowed, irrecoverable debts, and you can ignore allowance for doubtful debts here. Use of purchase ledger control account. Again, we have a figure. The first one at the top, we have a trial balance summary at the beginning of the year, then at the end of the year, and in the bottom we have bank summary. Now if you want to construct a purchase ledger control account, payments to trade payable, when you purchase ledger control account is actually liability. When you have paid to someone, you can, like according to the rules, you have to debit that account. So here purchase ledger account is being debited by payments to trade payable. Balance brought down 1st January was 20,800 pound. This is a liability, so it's on the credit side. During the year, we have made a payment of 82,600 pound. When we balance it, we got a balance carried down amount 16,000. Now purchases, missing figure, like what we have purchased during, we got all the payment, like all the complete amount what we need to pay to someone. We got carried down balance, we don't got a brought down balance, so it's easy to find the purchases figure, which is 98,600 minus 20,800 is equal to 77,800. Use of sales ledger control account, again the same picture. Now sales ledger control account is an asset account. So the balance brought down usually on the debit side, then receipts from the receivables, when like it's an asset account. When somebody pays, then this asset, then a bank account or cash account has gone up. So sales ledger control account, which is our asset, has gone down. So it needs to be credited. So if we receive any money during the year, we have to credit the sales ledger control account. Here we have received £127,800 during the year, so sales ledger control account is being credited by this amount. When we try to balance it, the carried down balance is £20,400. Now we got three amounts, we got three figures. It's easy to find the fourth one, which is your sales. So in order to calculate the sales, £148,200 minus £29,200 is equal to £119,000, which is the sales for this. Expenses for the year. Expenses for the year is equal to bank or cash payments minus accruals at the beginning of the year or plus prepayments plus accruals at the end of the year or less prepayments at the end of the year. Using expense control account, administration expenses control account, we have this example. Balance brought down was credit balance £200. Then during the year we have paid £30,600 in the form of administration expenses. When we try to balance it, we got larger figure on the debit side, which is £30,900. On the other side we have only £200. So the missing figure, which will go to the statement of profit and loss, can be calculated by just simply 30,900 minus 200 is equal to £30,700. Gross profit markup. It is common for a business to decide on its selling price by adding a percentage to the cost price. This is known as gross profit markup. A business decides markup of 25% to the cost of the goods as profit. Goods bought for £100, a markup will add 25% to establish the selling price. So £100 multiplied by 25% is equal to £25. The gross profit is £25 and goods will be sold for £125. It means cost price multiplied by markup percentage is equal to profit. Cost price plus profit is equal to selling. Gross margin. A margin tells what percentage of the selling price figure is profit. If selling price of the goods is £100 and we have a margin of 25%, then we know that the profit is £100 multiplied by 25% is equal to £25. If £100 is the selling price, £25 is the profit, then cost price will be £75. Selling price multiplied by margin percentage is equal to profit. Selling price minus profit is equal to conversions of markup and margin. Converting a markup to a margin. Formula: markup percentage divided by 100 plus markup percentage multiplied by 100. Example: if markup is 25%, then 25 divided by 100 plus 25 multiplied by 100 is equal to 25% margin. Converting margin to a markup. Formula is margin percentage divided by 100 minus margin percentage multiplied by 100 is equal to markup. Example: if margin percentage is 20%, then 20 divided by 100 minus 20 multiplied by 100 is equal to 20.